Performance goals, those are a critical component to the design of compensation packages for most companies. So let's spend some time talking about those. Julie, do you find that compensation committees receive meaningful input and updates on the progress being made toward the achievements of those goals during the performance period? And do you think there are best practices that companies should adopt to deliver this information?
Well, first of all, I think you have to make sure that you do. I mean, I think the comp committee has to make sure that they do get that and request it. I'm on one board where they update it literally at every meeting, and on other boards where it's more of a semi-annual kind of update. We had one board where they were hoping to not ever do it ever, but you have to. But I think I do think it's very important to keep updated and to always know where you stand along the however many years this is spread over. But you have to make sure that the management team is willing to provide what you need and just insist that they do. And they will. Yeah.
Yeah, my experience has been the same. I get generally updates every meeting that we have, on how they're performing. I mean, the art for compensation committee is trying to make sure that the metrics that you're using for the compensation mirror the shareholder experience. And so, part of what you're also trying to do is just figure out, okay, what is it the shareholders care about, and measure that. And so, if you do it well, you're also you're in a position where they're updating the street constantly as well. So the street knows how they stand, we know how they stand, and it eliminates a lot of the vagary that you might otherwise have to face. And obviously, things that are measurable. That really tie into the financial statements, that are auditable, all objective, that all makes the best metrics.
Yep. And so, Julie, speaking of the objective metrics, how should the compensation committee view the mix of objective performance measures and discretionary personal performance goals?
I really like objective performance goals. I'm not terribly big on discretionary ones because I've seen at companies where they try to push through some really, I've all seen it, some really kind of pitiful excuses for, I'm going to develop as a person, I'm going to lose weight. And I just think, well, okay, but you should be doing that on your own anyway. That shouldn't be, that's not part of your performance goals. I like objectives. I like where you can set and back to what Mark said, we all talk to our shareholders all the time, and we know what they want. And I think you have to tie it into that and try to make it be in parallel with that. So, some discretion might be fine, but I think it needs to be very, very limited and still have something to do with the business in some way. So,
I mean, even without explicit qualitative components to your plan, you're still at some point probably going to have to exercise some judgment, even against the formulaic metrics. And I think back to the question about the consistent updates, I think that can help as you're consistently being updated through the year. You can identify places where the plan is starting to get out of whack with what shareholders are experiencing or how management views the year. Like, this is, God, we're blowing and going, it's a great year, but the annual incentive plan metrics don't look like a great year. You can start that conversation early because it never works well to surprise anyone with your expectations. I mean, if you have a losing weight goal, just let them know where your weight is during the year, so at the end of the year they're not surprised about what you're going to recommend for your bonus.
I honestly like having some subjectivity. Not tons, but 20% or so. The problem is you're setting metrics usually at the beginning of the year on a budget, and particularly in the energy business, you just never know how to really. You're doing your best based on forward forecasts, but what I figured out over my career is all those forward forecasts are all wrong, right?
true.
And the second thing is, and this is particularly true in the E&P space, where a lot of your metrics are driven or are very sensitive to oil and gas prices. You can set a metric based on, but things can change dramatically for a management team just based on the price moving, which they have no impact on.
Right.
And so sort of having the ability to, again, to your point, let's understand how are shareholders looking at this? How is this performance looking vis-a-vis, the performance of others in the industry. Does this look like best in class, or does this look like they're lagging based on what they're doing? Did they set the budget too easy based on what oil prices have given them, or were they really hard on themselves and the market has moved away from them, but they're outperforming everybody else? That discretionary element gives you some ability as a board to make sure that you are rewarding people for what they're contributing, or to pull back and say, look, this was a gift. The market gave you a gift, and we're not going to necessarily pile on.
Yeah.
And I, at least my experience has been, shareholders have appreciated the judgment. If it's well explained in the proxy, they appreciate the level of judgment that the board's playing on the top of it.
Putting in. And so just to follow on to that, how do you view the challenges between short-term and long-term performance objectives? How do you see each of those playing out in terms of the judgment the compensation committee applies?
Well, long-term, because you have the ability, I think the market can kind of even it out. That's where it ought to be really objective, right? And I think that the linkage to, shareholder return metrics, cash flow, in the E&P sector right now is huge, right? Cash flow per share, those kind of metrics all are key. And, if it's a 2 or 3 year program, the market's going to kind of even it out. And I think the discretion doesn't have to be quite so. It's really the annual objectives where
More.
It's just exactly. Even seasonality can really influence. What do you see?
Well, I agree. So in the annual plan, I also think it's much more important to have line of sight, which you can get at with qualitative metrics that sometimes you can't with a lot of the outcome measures that are kind of in long-term plans. So you have total shareholder return, which is kind of an outcome of having done all the right things in the annual plan during that performance period. They build to that growth in shareholder value, hopefully, over time. And that's where you direct behavior, I think, more through the short-term plan. And you can do that with qualitative metrics or strategic goals that tell people specifically some things to do besides just we're trying to generate cash flow. So that it can be helpful in that respect.
So, David, I have 2 questions for you. First, could you hand me that iPad in case somebody's asking a question? Keep an eye on that. And second, how are companies reacting to the shifting landscape these days of the peer groups with all this M&A activity? And how difficult is it to set long-term goals against this moving target?
Yeah, I would be surprised if we don't have most people in the room here have had some conversation sometime this year about how you're going to handle the impact of M&A on selecting peers, either for benchmarking pay opportunities or for measuring performance. So relative TSR in a commodity exposed industry like oil and gas can be a very powerful measure to see how well you're performing in spite of those exogenous variables that you can't impact. But when you have 10 peers in the peer group and 2 or 3 of them get acquired, that payout scale can start to do some funny things by the time you get to the end. You could move up 1 position within the peer group and have a step change in your payout, and it may not seem appropriate. So we've had a lot of conversations with clients both on the front end about picking a robust enough peer group and setting criteria around managing that peer group through the performance cycle. Like, when somebody is acquired, how can we manage that so that we don't just lose a company out of it? And then on the back end, just kind of trying to manage those situations where you do have judgment in your grant agreements. What's the right judgment? And usually what you end up doing is you end up looking at a sort of a default approach, like we're just going to pull the companies out, and also let's look at 1 or 2 other approaches and track them through the performance cycle, like keeping companies in where they were acquired, converting them to an index through the rest of the cycle. And then when you get to the end, that'll be a situation where there's maybe not discretion in the plan explicitly, but you have to make a judgment call about what's the best reflection of both balancing what management did and what shareholders experienced.
So here's a question we have from the audience. I'll throw it out to each of you. How do you ensure management isn't sandbagging performance?
Everybody in here's been accused of that on the management side. Well, I mean, I think they're approving the budget, and generally speaking, you're measured against the budget and other operating criteria that the board's approving. So therefore, if they're approving the budget and they think that's sandbagged, and that's an issue, but they need to solve it at that point. But otherwise, like I said, okay, maybe y'all haven't been accused of sandbagging. But I mean, to me, it's very hard to sandbag if the board's approving the budget, and they do, and they know what to expect, and I just think it's hard. It's hard to get by with that.
Part of it is obviously during the budgeting cycle, do sufficient pushback, right? If you just sit there and you just take it and for what it is, you're going to get their softest plan. And I don't have a problem because I know it's disclosed. One of the things that we did at Marathon, which I've been very pleased, is we'll do threshold stretch, or plan, but in order to get stretch objectives, they have to be the best in class, best of their peers on those metrics. And so that kind of takes a little bit out of it. It's like, okay, yeah, you can maybe fudge some of these things, but if you're going to get your max payout or whatever, it's going to be whoever in your industry group is the very best at whether it's reinvestment rate or cash flow per share or whatever. And so how you calculate at the end of the year, you go get it very objectively. Here's what the best in class was. Where are you in the middle of that? And it kind of takes a little bit of that out. So they're actually incented to start pushing their plan toward what they believe is going to achieve that best in class.
And you've touched, we got another question here, and I think you touched on that to some extent. It says, what suggestions do you have for setting compensation targets when management maxes out on every objective year after year, and dealing with our management when you want to put greater stretch into the numbers?
Well, that's it. I think if you can demonstrate to your shareholders that they are indeed performing best in class, I don't mind paying, top bonuses on that basis. And our experience was neither did our shareholders, and it did reflect in the shareholder experience. They were one of the best performing stocks. So it's like, okay, that created a lot of alignment, and it took a little bit of the pressure off the board to try to sort of guess, 14 months in advance what that best was going to be.
Mm-hmm. And the question about managing management expectations about getting a certain level of compensation that's stable from year to year, doesn't go down, even if the performance varies. Do you have tips on that?
Well, I mean, I'm sorry.
Go ahead.
Well, so I think first of all, there's a philosophical question about that, whether that's what you want to do with your plan. Whether you want the outcomes from the plan to mirror more what shareholders are experiencing through cycles, or whether you want to maintain something more stable. In which case, I would argue you might have a philosophy where the upper and lower bounds of what you can earn are narrower. So some of the downside may be gone, but some of the upside is gone. So there's some philosophical questions about how you want to handle that. The oil and gas industry got burned leading up into COVID because for so many years you saw bonuses happening up here, way above target within this range, and shareholder experience down here. And some of that was driven by a desire to make sure that the incentive plans were measuring management's line of sight in spite of commodity price, which is a reasonable philosophy, but at some point then you have to go back and check, does this seem fair in light of what shareholders are experiencing?
On Westlake, one of the things we do is actually based on EVA, economic value added, and if anybody's sort of looked into EVA, again, it's a shareholder return metric, aligns well with shareholder return, but the plan itself actually includes a banking mechanism so that if they max, the top sliver of that compensation goes into a bank, and so if in a year following, they don't get everything, they can pay out of the bank, and it starts to smooth
Smoothing.
out.
It's a
Exactly.
smooth
Yeah.
But it's a great retention tool as well, because people all of a sudden have a lot sitting in their bank, and they don't want to leave because they would forfeit that if they walked out the door. So very low management turnover.
I don't really have anything to add other than, I just think you have to always keep shareholders in mind, back to your point, as to how you're doing all this. And I'm not a big proponent of keeping it real narrow. I mean, I believe in years where if they're knocking it out of the park, they should be rewarded for that. But conversely, they have to understand that, you have to keep, and you have to communicate to me that very well during the year, because otherwise, people get spoiled and they think they're gonna get up here and then not. So I think communication is key, for the employee group in that.
We have another question, I think, on these topics. Are your boards discussing and monitoring CEO compensation relative to the other key employees and average employee compensation?
I have one board that actively does that. I can't say that all the boards that I serve on do that proactively. But it's talked about, but can I tell you that we go through the full exercise? No, we don't. But we do, it's in mind, we know what we're supposed to be doing and try to keep it in the fair way, but I can't tell you that we're doing the full test. So,
I mean, the same. I think we look at it. It's a difficult metric. It's just kind of it is what it is.
Yeah.
I think that the better process is look at the peer groups, study it, and not just pay attention to the CEO, but pay attention to what's happening below that. Even if you're not back, you're giving a lot of discretion to the CEO, make sure that everybody's staying kind of at that same. If you're targeting 50%, the 50th percentile, make sure everybody's there. And I think that takes a lot of the risk out, in my view.
And I think that, the specific ratio of the CEO to the median employee, I don't know of any, I don't have any committees that regularly talk about that. But with the rising importance of human capital kind of making its way into the compensation committee, you do hear a lot more qualitative discussions about how do employees feel about what's going on? Are broader employees included in the incentive plan that you're reviewing with us? How do they feel about it? Are the outcomes for the executives different from what the rest of the organization is experiencing, and how does that feel? And so you kind of get at it that way without looking at a specific ratio.